Hello, and welcome to another episode of Darwin Investors. Today, we're going to talk about what was in those Federal Reserve minutes that caused this stock market to get a bit spooked. We'll talk a little bit about PMI data, CPI data, and we'll also talk about what I'm going to do with this market going forward. Now, before we dive into the Fed minutes, we got to do just a little bit of vocabulary so we kind of understand what they're talking about here. So the first thing we'll explain is what the yield curve is, just really briefly. Basically, yield curve is just like X, Y axis. Interest rates would be on the Y axis, and time to maturity would be on the X axis. It's generally considered healthy if the curve goes like this, meaning the 2-year pays less than the 10-year. Because that's an indicator that, let's put this like in the context of a municipal bond or a corporate bond. You're saying that you're willing to take on the larger risk for a 10-year corporate bond because you think this company is going to be around in 10 years. They'll continue paying a higher interest and give you all your money back after 10 years. What we're saying when the yield curve is inverted is we don't think that the long-term outlook is that good for this company. And in the case of a treasury bond, what we're saying is the economy or the GDP is better now than we think it's going to be in 10 years. And so basically what this is an indicator that a recession it might be on the way. And there's been a lot of studies that show, at least since the 80s, that demonstrated that within about 2 or 3 years of an inverted yield curve, a recession happens. So what's the implications of a recession? Well, when a recession happens, unemployment skyrockets, there's a fall in income, but most importantly, what affects the stock market is that there's a fall in asset prices, meaning the stock market really takes a dive. So the inverted yield curve is a big deal. Now, the second concept that we have to understand is basically the concept of interest rates. And so let's say that you go to an airport, and this is like an example that I like to use. That you go to an airport and you're sitting there and they say, will you give up your seat for $300? And they say, no. $400? No. $500? Okay, fine, I'll give up my seat, right? I'll go to the bar and whatever, eat a burrito. That's what they do with bonds, essentially. They say, will you buy this bond for 1.1%? No. How about 1.2? No. How about 1.3? 1.4? Well, fine, I'll buy it for 1.5. And so that's how they determine an interest rate on a bond, is just basically they'll keep cranking it up until they're able to unload these bonds, or essentially unload the debt. So that is a background. We'll go ahead and dive into the Fed minutes here. So on December 15th of 2021, the Fed met, and they gave a briefing over what they spoke about. And most of this data that's in here, we already know. It's pretty public. For whatever reason, you turn on TV, it seemed to spook the markets. I'm not sure why they didn't know this. But I did a couple of videos with an Excel spreadsheet detailing what they said in this. I brought up their own CPI data, summary of economic projections that were released as a result of this meeting. But there are certain things that were not spoken by Jerome Powell that are in this meeting, and one in particular had to do with the Fed unwind, like basically flooding the market with treasuries, and at the same time doing it faster and doing it on a larger scale and doing it quicker. And so that really spooked, because they never really said they were going to do that. So that's in a nutshell what has done this. But let's just go through this minutes real quick and find out what was in here that could have spooked it. Financial markets responded to significant new information about the economy and monetary policy, as well as the emergence of the Omicron variant. Expectations for an earlier reduction in Federal Reserve policy accommodation lifted short-term interest rates and supported the dollar, while prices of equities that are sensitive to COVID-19 risk declined significantly. Over the period, market participants considered potential drivers of the notable decline in far-forward sovereign yields in the United States and other advanced economies. News of the Omicron variant reportedly drove safe haven flows into sovereign bonds. So like we said, if you've got a bunch of people buying it at low rates, so far forward sovereign yields were coming down, and there was a lift in short-term interest rates. So there was a concern that we were having an inverted yield curve. And the concern is that we're basically going to go push ourselves into a recession, and the stock market's going to fall. So this is something they were discussing, and this is something that spooked the markets. In addition to the effects of the pandemic on risk sentiment, some discuss the potential for COVID to become endemic, possibly resulting in modestly lower potential growth over time. So they're now saying that it's a slowdown in GDP and an inverted yield curve. Like basically they're laying down all the foundation for a recession. Regarding the outlook for U.S. monetary policy, expectations for reduction in policy accommodation shifted forward notably, basically saying that we're going to taper faster. This we already knew. This should not have shocked anybody. And again, they're talking about a faster taper. What they were saying was that the median respondent projected net assets per share, and in March 2022, the median respondent's projected timing for the first increase in the target range for the federal funds rate also moved earlier from the first quarter of 2023 to June of 2022. Again, this is something that should not have spooked anybody. I did a video where I already showed this spreadsheet here, and basically the Fed was buying back $120 billion of bonds and securities. It, had been doing it for a long time. As of October, they were buying $80 billion a month in treasuries and $40 billion a month in mortgage-backed securities. And then they said they would implement something called quantitative easing, where they basically buy back less every month. So that in November, they said, we're going to taper. I'm sure we've all heard that. We're going to taper starting in November. So they're going to taper buying $10 billion less of treasuries and $5 billion less a month of mortgage-backed securities. Effectively, taper would be complete in 8 months of 10 and 5, right? So in November, they did 10 and 5. But then this meeting came, they said that we were going to double the taper, right? So they said, okay, well, we're at 70 and 35, we're going to double it. So now we're going to be, after buying back instead of 10 and 5, 20 and 10, we're going to be at 50 and 25. In January, we'll be at 30 and 15. In February, we'll be at 10 and 5. And in March, it'll be over. And as soon as it's over, we can begin interest hikes. And they said June. I don't know why it can't be April, right? So that's essentially what they're talking about. And that really spooked the market, but I'm not sure why. This is all information that we should have already had. At least I was already doing videos about it, so I'm not exactly sure why it spooked the market. Turning to desk operations and money markets, the manager noted that the desk had reduced net purchases of treasuries and mortgage-backed securities in accordance with the directive issued in the November meeting. Overall, the transition to a slower pace of purchases had gone smoothly. So essentially, the taper was going smoothly. In money markets news, the path had emerged to a resolution. A debt ceiling impasse led to yields on a treasury bills maturing in December and January to decline. So even though they're buying back less securities and treasuries, the bond yields were not rising. Interest rates weren't rising. Why is that? Well, people were probably coming in from all over the world buying our debt. Now, remember, other people are having the same problem we're having. And so our interest rates are pretty good relative to the world. And plus, we pass this debt ceiling, we pay our bills, right? So we're a guarantee. So even though another country might pay a higher interest rate, you're still going to buy your bond from America because we will pay you back, right? So we're basically considered AAA rated. And then this is what I think spooked the market. So here's the discussion, and the key word here is discussion, but then it gets a little spooky. Discussion of policy normalization considerations. Participants began a discussion of a range of topics associated with the eventual normalization of the stance of monetary policy. The topics included the lessons learned from the committee's previous experience with policy normalization, alternative approaches for removing policy accommodation, the timing and sequence of policy normalization actions, and the appropriate size and composition of the Federal Reserve's balance sheet in the longer run. No decisions regarding the committee's approach were made at the meeting. So they're going to talk about this. No decisions were made. Now, this is the reason why Jerome Powell didn't come out after this meeting and discuss this, is because no decisions were made. They're just throwing it out there, and this person who typed this up is now listening to all this, and they put it in the minutes, but Jerome Powell never briefed it because there was never a decision about it. Probably because he didn't want to spook the markets because they hadn't made a decision yet. I wouldn't talk about it either. All right, let's get to some monetary. So this here says that changes in the target range for the federal fund rate should be the committee's primary means for adjusting the stance of monetary policy in support of its maximum employment and price stability objectives. Basically, what they're saying is that they weren't going to worry about inflation until we had maximum employment. That was the thing, and they would kind of let inflation kind of get out of control because they're like, you know what, we're going to keep pumping money in the economy until we have full employment. That's just what we're going to keep doing. We'll worry about inflation when we get there, but right now we need full employment. Let's see. And the most notable participant remarked the current economic was much, okay, so this is interesting. So most notably, participants remarked that the current economic outlook was much stronger with higher inflation and a tighter labor market than the beginning of the previous normalization code. So what they're saying is that we have a very strong economy. We have a very nice labor market now. So we can begin this period of interest rate hikes, quantitative easing, and unwinding of the federal balance sheet. And we can do that because we don't think it's going to rock the economy so bad. And that's their job. Their job is to try and stabilize the economy. But then they said the balance sheet could potentially shrink faster than last time if the committee followed its previous approach in phasing out the reinvestment of maturing treasury securities and principal payments on agency and mortgage-backed securities. So they're saying that, okay, now we're throwing, okay, we're going to unwind the Fed's balance sheet. They bought all of these treasuries. Now they're going to flood them back out there and sell them back and basically bring our balance sheet back to try and get it closer to zero than where it is now, which is like 10 trillion. And so they're going to try and do this unwind. And now they're saying we're going to do it and we can potentially shrink it faster because our economy is so strong. It won't rock us. Okay, so that spooked people. Participants also judge the Federal Reserve to be better positioned for normalization than in the past. They're saying our economy is really strong. We should be able to pull this off, right? And then some participants judge that significant amounts of balance sheet shrinkage could be appropriate over the normalization process, especially in light of abundant liquidity in markets and elevated usage of the ONRRP facility, which is the reverse repurchase, or basically sending the securities back out there and lowering the balance sheet of the Fed, essentially the unwind. Again, with the runoff, participants had an initial discussion about the appropriate conditions and timing for starting balance sheet runoff relative to raising the federal funds rate from the ELB. They also discussed how this relative timing might differ from the previous experience, in which balance sheet runoff commenced almost 2 years after policy rate liftoff, when the normalization of the Fed funds rate was judged to be well underway. So it normally takes about 2 years after the first interest rate hikes to start doing a Fed balance sheet runoff. That would be the normal thing. But almost all participants agreed that it would be likely appropriate to initiate the balance sheet runoff at some point after first increase in the target range for the federal funds rate. However, participants judged that the appropriate timing of balance sheet runoff would likely be closer to that of policy rate liftoff than in the committee's previous experience. Now they're reading this, they're going, wait a minute, we're going to have an unwind. They didn't talk about that before. And now instead of being 2 years out, it's actually be faster than or like sooner in time than normal. So it's going to happen and it's going to be sooner than normal. Okay. They emphasized that the decision to initiate runoff would be data dependent. Okay, that's good. So they're not going to do it willy-nilly. They're going to rely on data and decide what was a good amount to do this. Some participants commented that the removing policy accommodation by relying more on balance sheet reduction and less on increases in policy rate could help limit your yield curve flattening during policy normalization. So again, they're concerned about throwing us into a recession. They don't want the flattening yield curve. And I like this, actually. So now they're saying, remember they said they emphasized that the decision initiative would be data dependent, right? So they're saying, what if we start running off our balance sheet? We're going to send more bonds out there, right? And that means that the interest rates are going to go up. Well, if we're already sending the interest rates up and that's curbing inflation, then why would we need to lift interest rates? We're already doing it, right? So that's what they're talking about here. And again, this is a discussion. Nobody said anything that they're actually going to do it. Many participants judged that the appropriate pace of balance sheet runoff would likely be faster than it was during the previous normalization episode. Many participants also judged that monthly caps on runoff of securities could help ensure that the pace of runoff would be measured and predictable. Okay, so now again with the runoff. So now they're saying we're going to have an unwind. It's going to happen sooner than the normal 2 years. And when it does happen, it's going to happen at a faster pace than it normally happens. And they're saying that all this is because we have such a strong economy, we can take it. They're saying that basically, even though it's going to be a faster pace, there will be a monthly cap on the amount that they can send out there. But again, they just keep talking about this. They won't let it die. So this spooked people. Let's see. Money markets. Okay, that might be. Again, with the runoff. Okay, so staff review of the economic situation. Labor market conditions continued to improve in October and November, and measures of compensation had sharply risen so far this year. So again, we're talking about we have a tight labor market. We got wages increasing, so that's good. This measurement. Okay, and inflation reads remained high. This we knew, and various indicators suggested that inflationary pressures had broadened in recent months. So, okay. So there's basically more inflation over more things they look at that cause inflation. I tend to look at just a few things. I look at food, energy, shelter, and oil and gas and stuff like that. Those are the things I look at. Everything else looks like to me like I don't have to buy a new car. I don't have to buy a used car. I don't have to go on vacation. These are all things I don't have to do. But when you look at those core things, to me, that's where inflation data really hits home for me. All right, so real PCE growth appeared to be picking up in the fourth quarter despite an upturn in COVID-19 cases. Okay, now this is good. The waning effect of previous fiscal stimulus measures lingered, supply bottlenecks, and recent increases in consumer prices. So they're saying that there was an upturn in growth despite an upturn in COVID cases. Basically, like the market's just brushing off and the economy's just brushing off Omicron. So they're like, okay, this is good. In November, however, the components of the nominal retail sales data used to estimate PCE stepped down, possibly reflecting some holiday sales having pulled forward to October. Now, remember, this is done in December 15th. If we look at December after the December 26th, retail sales up 8.5% this holiday season. So this is outdated, okay? So just kind of keep this in mind. And also when they say when things go later into next year, they're not talking about now in January 22, that's going to be the end of 2023. They're talking about the end of this year. So when they start talking about things going into next year, they're really talking about this year. And the manufacturing output increase in October and available indicators of production were consistent with another gain in November. We'll look over the PMI data here in a minute that talks about manufacturing and how that's going, the supply chain bottlenecks, inflation, and things of that nature. So we'll take a quick look at that after this. After reaching a record level in September, the U.S. international trade deficit narrowed in October, reflecting a large rebound in exports. Again, with the strong economy, we're sending stuff out. We're rebounding. The export rebound was broad-based with sizable increases in real exports of industrial supplies, capital goods, agricultural products, and consumer goods. And these are a lot of the parts of the market that are actually going up right now. People are like, well, this is what's working according to those Fed minutes. Staff review the financial situation. Over the intermeeting period, rising inflation and FOMC communication appeared to have put substantial upward pressure on shorter dated treasury yields. Again, with the yield curve inversion, they're saying that inflation is meaning that they're not interested in those long-term treasuries, just the short ones. And we're going to pump out a lot of them, and we're going to force the interest rates up in order for you to buy them because there are going to be so many out there. Pandemic-related fears, as well as concerns about inflation and tighter monetary policy, apparently weighed on risky asset prices despite continued robust economic data. Okay, so I don't know, so basically, this is actually really important now I think about it. Pandemic-related fears, as well as concerns about inflation and tighter monetary policy, apparently weighed on risky asset prices despite continued robust economic data. So this is what's killing those low PE stocks. Like basically, they're considered a risky asset, right? Even though there's robust economic data, pandemic-related fears, as well as concerns about inflation and tighter monetary policy, are killing those low or those high PE stocks, I should say. They're killing the ones with no earnings or very little earnings. Overall, financial conditions for businesses and households remain accommodative, so that's good. Market participants' view on the expected path for the federal funds rate, as applied by a straight read of overnight swap index, suggests that they had pulled forward expected rate increases more into 2022 and 2023 compared with the timing. So this really spooked the market. Again, we just done that Excel sheet. We knew that the rate increase was going to be pulled forward into 2022, and it wasn't going to be delayed until 2023. That we knew that because the tapering was going to complete in March. They're probably going to likely start it in April. They're talking about maybe having 4 rate hikes this year. You know, maybe they will, maybe they won't, but I doubt that they will. That's my personal feeling. On net, inflation compensation had declined moderately since the November FOMC meeting, as heightened concerns about the inflation outlook appeared to be outweighed by increases in the perceived prospects for tighter monetary policy and fears about the course of the pandemic. So here, the inflation worries were waning. Like, they're basically saying, and this is super important to me, because broad equity indexes were little changed on net since the previous FOMC meeting, as strong economic data appeared to offset concerns regarding monetary policy, inflation, and the pandemic. So this is what happened in November. There was just a flood, and we're getting it now, by the way, in January. It's the same exact thing happening now, happened then. We're getting just this flood of horrible news, and nobody buy anything. Let's all get out of the market. It's all awful, awful, awful. But then earnings started coming in, right? And we were finding, wow, we have strong economic data. We're getting better revenues than ever before seen in these companies. We're having better profit margins than ever before in these companies. There are stock buybacks left, right, and center. Well, you know, because there's nothing to shut a bear up. Like, here, there's your data. There's nothing to dispute here. We're doing fine, right? And that's what I think is going to happen this month, is that we're going to get all of this fear, and then the banks start to report next week, right? In late January, we have the FANG report. You know, Microsoft, Apple, and all of them are going to report then. And guess what we're going to find out about these companies? They're fine, right? They're making plenty of money. And so that's what they're talking about here, is that equity index were little changed on net since the previous FOMC meeting, as strong economic data appear to offset concerns regarding the taper, inflation, and the pandemic. Credit scores of corporations remain solid. You know, there was plenty of borrowing going on. Municipal bond market was robust. People were buying those bonds. Let's see. Mortgage originations for home purchases was fine. So, and then now we got the staff economic outlook, right? But again, we knew all of this. It was in the summary of economic projections. And we'll just go over this real quick. The projection for U.S. consumer price inflation prepared by the staff for the December FOMC meeting was higher than in the November projection. The near-term outlook was revised up, reflecting faster than expected increases both for a broad array of consumer prices and wages. Supply chains bottlenecks were seen as continue to put upward pressure on prices. So we're saying there's some inflation there. As a result, the 12-month change in PCE prices was projected to move up further relative to October's pace and to end the year around 5%. Well, we know that because it says right here in the CPI data, is that the PCE inflation, this is right out of the summary of economic projections that was released on 2 p.m. on December 15th after this meeting, that the inflation was going to be 5.3% at the end of 2021, and then would decline to 2.6, 2.3, 2.1, and finally settle in at 2 in the longer run, right? So we knew all this. Over the following 2 years, the boost to consumer prices caused by supply issues was expected to partly reverse, and energy prices were projected to decline. I guess partly reverse would be their way of saying inflation was going to go backwards, and energy prices were projected to decline. PC price inflation was therefore expected to step down to 2.1% in 2022 and to remain there in 2023 and 2024. Well, that's not exactly what they wrote here. They said it would go down to 2.6, and then 2.3, and then finally to 2.1. Longer run inflation was still assumed to remain anchored at 2%. And again, that's where they have it here, inflation at 2%. So none of this should have been a surprise. I don't know why people were so thrown off by this report here. A summary of economic projections released to the public following the conclusion of this meeting. That's what we've been looking at. The supply and demand imbalances. Now, this is, I think, is interesting. Supply and demand imbalance related to the pandemic and the reopening of the economy had continued to contribute to elevated levels of inflation. Now, why do I think this is interesting? So basically, about a year and a half ago, a year ago, what could we do? Could we get on an airplane? Could we go to restaurants? Could we go to football games? Could we go to concerts? No. All we could do was shop. That was it. Nothing else. There it was. Amazon, Walmart, Lowe's, you could do home improvements, whatever, but you couldn't spend your money anywhere else. Plus, there was a bunch of money being pumped into the economy. And so with a bunch of demand like that, it was hard to keep these supply chains open, right? Or like going fast enough to meet our demand. But now we can do all these other things. There's less liquidity being pumped in the market, but also the money that we do have, and we know that the household finances are fine, at least according to this report. The household finances are doing really well, but we have more stuff to spend our money on. You know, we can go to football games, we can go out, we can go see our families in whatever state or whatever. We can do something else with our money. It doesn't just have to be buy stuff on Amazon, right? So that's why I think supply chains are going to eventually just kind of let up, or kind of organically. Participants commented, and actually we're going to find out that's the case when we look at this PMI data that just came out 3 days ago. Participants commented that the path of the economy continued to depend on the course of the virus, and easing of supply constraints was expected to support continued gains in economic activity and employment, as well as reduction in inflation. Exactly. So basically that is what's happening. And we'll look at the PMI data that show that we are having an easing in the supply chain. We are having an easing in inflation. And our CPI data will show that there has been an inflection in inflation that started in December. And then that's good, because an inflection in inflation would mean maybe we don't need to really raise interest rates. The whole point of raising the interest rates was to bring down inflation. If inflation is coming down anyway, maybe we don't need to raise interest rates either that high. Many participants noted that the emergence of the Omicron variant made the economic outlook more uncertain. Several remarked that they did not yet see the new variant as a fundamentally altering path of economic recovery in the United States. Okay, so they're saying that Omicron is really not going to affect us too much. That's great. We know that. Let's see, supply chain, we'll go over that in a minute. While participants generally continue to anticipate that inflation would decline significantly over the course of 2022 as supply constraints eased, almost all stated that they had revised up their forecasts of inflation for 2022, notably, and many did so for 2023 as well. Again, they laid all this out, and maybe that's the reason why it's higher here. They brought it up from 2.1 to 2.6 to 2. But in any case, they laid it out there for us. So that shouldn't have been a surprise. Several participants remarked that they view labor market conditions already largely consistent with maximum employment. Okay, so now they're saying, remember the whole reason that we could raise rates was if we was contingent on reaching maximum employment, and now they're saying that we're there, so we should be able to raise rates. And again, we should have assumed that they were going to do that anyway as soon as the QE was done. In light of elevated inflation pressures and the strength of the labor market, participants judged that the increase in policy accommodation provided by the ongoing pace of net asset pressure was no longer necessary. Yeah, I mean, that's the end of the taper. Okay, let's get to something that's new. This was basically what Jerome Powell, what he said. This was released to the vote also encompass approval of the statement below for release at 2 p.m. So then Fed Chair Powell comes out and he says all these things. But nowhere in here does he talk about unwinding, a timeline of the unwind, and how much, like how much is going to come. It's just basically they talk about the taper, and I guess they never really said they're going to increase interest rates, but I mean, I just assumed that they would start interest rate hikes as soon as the taper was done. That's just my assumption. I guess they never really said that either. So then maybe that's why it surprised people. Interest rate hikes and the unwinding of their balance sheet. And so they said basically we're gonna hike up interest rates, but I guess, which I guess he never said. I just assumed that they would, and that they were going to unwind their balance sheet, and that the balance sheet unwind is going to happen faster, and it's going to happen sooner. It's going to be a faster unwind, and it's going to happen sooner in time out than they anticipated. But again, that was just a discussion. Nobody ever said it was going to happen, and that's the reason why. It wasn't in his minutes here. So let's look at our PMI data. Now, this came out just 3 days ago. What is PMI data? Well, PMI data is the Purchasing Managers Index, and the PMI is based on a monthly survey sent to senior executives in more than 400 companies in 19 primary industries, which are weighted by the contribution to the US GDP. The PMI is based on 5 major survey areas: new orders, inventory levels, production, supplier deliveries, and employment. So when we look at this data that just came out 3 days ago, they're saying that longer lead times for inputs also led to another sharp increase in backlogs of work, albeit the slowest for 10 months. Meanwhile, cost burdens continued to increase markedly despite the rate of inflation softening to the slowest since June. So now we've got the inflation softening to the slowest since June. Efforts to pass through greater cost to clients were hampered by softer demand. So now we have demand coming down. We've got inflation softening because they can't pass the higher rates on to people. Finally, output expectations for the year ahead strengthened to the highest since November 2020. Optimism stemmed from hopes of reduced supply disruption and a greater ability to hire suitable workers. So right here, the PMI data is saying that the bottleneck is easing, that the price that they can pass on the consumer is also easing. So inflation is easing, and as is the supply chain. And so when we look at, this is our CPI data, the Consumer Price Industry Index Summary. And when I talk about that inflation is inflecting down, if we look at it in October, what we care about is, for me anyway, food at home. It went from 1% inflation to only 0.8. We look at energy, it went from 4.8 to 3.5. We look at fuel and oil, it went from 12.3 to 3.5. Electricity from 1.8 to 0.3. Energy in general from 3 to 0.3. This is an inflection downward, folks, from October to November. So when we look at the next release of CPI data, it's going to come on the 12th of January, right here. December 2021 CPI data are scheduled to be released on January 12th, 2022 at 8:30 a.m. Eastern time. So I predict that on January 12th, we're going to see yet a further decrease in month-to-month inflation, but they're still going to say it's an inflation rise year on year at that point. But what I'm going to pay attention to is it deflecting still further downward? And I predict that it will, because commodity prices are coming down, and the price of gasoline is also coming down. It's coming down. Prices fall a little or a lot depending on where you're living. So I think that that basically on January 12th, we're going to get a positive report there. I think the markets are going to absorb a lot of this, especially when all the earnings start coming out in a couple of weeks. So my overall take is I'm bullish, but I'm not bullish on your high price earnings, low earnings type of companies. I've already done my own version of an unwind. I got rid of, say, Airbnb today and replaced it with Microsoft. So now my portfolio is like, I'll go over that some other day, but it's like NVIDIA, Lowe's, Microsoft, Visa, Wells Fargo, JP Morgan, and GGPI. That's like 5% GGPI. So that's what I'm going to do. I'm going to be pretty aggressive going forward. This market doesn't scare me. I think that we're going to have really good earnings going forward. But then what I'm going to do after the earnings season is pretty much halfway over, or like, beginning of February, I then am going to maybe go into more cash, maybe sell out some of my cyclicals like my banks, stock up more cash, and then just kind of sell, or just sell covered calls, or look for opportunities to sell cash secured puts on some of those equities and take small gains. I think that's going to be the name of the game here from like February, while they do all these interest rate hikes and the taper is like finishing up. I think that the market's going to be quite bumpy between, say, middle of February and, say, July. And so I'm going to be happy with small gains. And that's going to be my plan going forward. If you got anything out of this, please like and subscribe, and then hit that little notification bell. For now, I'm out of here. Remember, I'm not a financial advisor, by the way, but I'm out of here, and we'll see you next time.